Welcome to the Plan, Grow, Read podcast.
To get started, the general economic outlook, just very quickly. So inflation is currently running at 4.6% as at 31 March, which is higher than what the Reserve Bank's target is. So, and that's why you've seen there's been interest rate increases over the near term. And based on the budget economic outlook, they're proposing that's going to probably peak at around 5%. If there's further crisis over in the Middle East, then that could go up to 7% inflation, which means more interest rate increases. I think the economy is in a situation where it's quite flat, and that goes to the next part about GDP growth. 1.75, that's stagnant. Based on population growth and everything like that, it's stagnant. And I don't think we've seen the impact of the interest rates coming through the economy yet fully. So I think we're in for a fairly flat period between now and probably the end of the year, and then perhaps into the new year as well. So, but the key thing is we've got to try and drive that economic activity. And one of the biggest things that we're struggling with in Australia, and there was an article came out I think today or yesterday about productivity, and Australia's ranked second last in productivity in the OECD, and that's a big problem. We're not just getting the output that we need from the available workers and from business activity to stimulate the economy to get that growth figure up. And that's something that's got to be a real focus for small business and business in general in Australia to try and work on that productivity. And I don't think the government's fully tackled that with the budget. And I'll go into that further if anyone wants my commentary on it, but it's my opinion only, not facts. And then wages growth is 3.3. So that's a positive and negative, because if you compare that to that, that means we've got real wages going backwards. Yeah, this is the headline, but the trim mean is the one they look at, and that is lower than that because they take out some of the volatility. Yeah, correct. But still, it's above where it needs to be. The logic is there's a blunt tool with the Reserve Bank. All they've got is one tool, really, and that's interest rates. It only technically affects, there's only 35% of the population has a mortgage. So it's quite narrow into who it impacts, but it's all about the sentiment and people trying to pull in the purse strings. But that's not good for us business owners, where we need rely on business to business spend or consumer to business spend. And it's really important that we try and get that economy stimulated, but get the inflation down into the range. Yeah. So growth. So there's real wages, negative real wages at the moment, and then the unemployment rate is still very low. So this is where we got this unusual, and we've had been in this cycle for quite a long time, where economic growth is low, inflation is high, but also unemployment is low. Normally, when inflation goes up, the economy slows down, the growth is not where it needs to be, population unemployment goes up. But we've got such a shortage of labour that it's keeping low in terms of the environment. So as I said, we're in a patchy situation at the moment. I call it mixed, and yeah, it's hard to get a read on it, but I think we're going to be pretty flat for the remainder of the year. That's part of it. A big chunk of the economy is coming from the public service. And so if you look at it's very, yeah, correct, yeah, and a lot of that growth. If you look at non-government growth, it's actually negative. I'm not going to get too political, but we've got fundamental issues, and when we get to the budget part, which we'll talk about now, and so I just want to I like this. This is thank you, Chelsea. Engaged is not married, and so proposal is not law. So this is proposals, it's not law. So don't rely on it. We've still got a way to go before we even get some legislation. This is all in effect press release or commentary without the detail. We get a federal budget pack where you can read all the intricacies of it, but it still doesn't go in enough detail to know exactly where it's going to stand. Then we've got to go through the political system of tabling the legislation. It's got to get through the lower house, the upper house. It's about control of those houses and whether there's enough people who will support the proposals as they are. But there's always a devil in the detail, and I'll explain that with a little one that they put through recently, where all looked great on the surface, but there was devil in the detail, which then caused a real issue for it. Yes, so yes, there've been significant proposals, but they're only proposals. So don't rely on it. They're not law, and they may change, and there's a likelihood there'll be some tinkering with it. But again, not trying to be political. They've got a large majority in the lower house. They've probably got enough support in the cross benches in the upper house to get most of this through. So that's just something to be aware of. So you're not going to see, I don't think you're going to see fundamental change, but I could be wrong. So while it's only proposals, yes, it is still a good time to talk about these things and then look at how it impacts your structure to work out whether there's things we need to consider but not act on in terms of what they're proposing. Because there's certain things which we'll go through in a minute, which have got different timeframes and when they come into play. So we've got some time to plan based on the proposed start dates for some of these measures. And then, yes, investment landscape will likely evolve over the coming years. And one of the ones we'll talk about is trusts and taxing a trust, capital gains tax. Let's jump into that. So the first one, negative gearing, they're changing that. And this one it's a timing issue more so than an absolute loss of negative gearing. So the way it works is that so it's important with the dates. So from 1 July 2027, so we've still got another however long that is until we get to that point, another 12 months roughly. So it's to do with residential property only, that they're going to basically stop negative gearing unless it's a new build. Now, what is the definition of a new build? We don't know that yet. So we can't comment on what that might look like, because it might be, what if I've got an existing property, I knock it down and then I build another one? We don't know any of that yet, but they're saying it's on new builds. Established properties after budget date can still offset losses against rental property income, but they cannot offset it against their salary and wages. So what that means is that you have to quarantine the loss that you incur against the same class of income. So at the moment, when you're negatively gearing, one of the joys of it is that if you make a loss on a rental property, you can offset that against your salary and wage, and therefore get the tax pack on the tax that's been withheld on your wage. Under this proposal, you have to quarantine that loss, and it can only be offset against future revenue from that investment. So it's quarantined. When you sell the asset or when you finally make it positive geared, that's when you can get that benefit. You don't lose it. It just gets stuck, it gets quarantined in a carry forward loss arrangement, and then you can offset that down the track. The challenge of that is if you have a property where you have got that negative gearing and it's the only property you've got, and this is based on my reading of it, and then you sell that property, you don't make a capital gain on it, and then you don't have any further income for that rental, then that loss cannot be used until you buy another property and then try and get that to a point where you can offset the loss against that other property. So it all comes down a bit about whether you sell that property for a gain or not, or whether you ultimately get that property to a positive geared, because in a lot of cases, people will sell the property before it's positively geared. So that's something to be aware of. But the really important thing is anything property owned before the 12th of May, so 7:30 p.m. on the 12th of May, anything bought before 7:30 p.m. on the 12th of May is grandfathered and therefore will still retain its the current rules. So any properties you currently hold that are negatively geared that you held at 7:30 p.m. and we're going to ask you, no, we're not going to ask you, as long as we see the records, you'll be fine. If the contract is unconditional, my understanding is you'll qualify. It's not settlement date, it's contract date. Yeah. So if you've already bought a property, but it's got to be unconditional. It can't be subject to finance or anything like that. It's got to be unconditional, is my understanding. Yeah. So what this means is that existing investors are largely unaffected, except for the capital gains tax, which we'll come to. But from a negative gearing point of view, it's status quo. So you're not losing anything if you've already got that property. It's only for any new purchases that it'll impact. And that's where we need to look at future property investment strategies, both not only whether it's new build or second-hand property, or also what structure we're going to hold that property in, if we've got the options of trusts, companies, individuals, etc., etc. So the changes are mixed when we get through the other two major changes, which is capital gains tax and trusts. So then you might need to look at diversifying away from property. So the whole mantra of the government on this one was to try and stimulate new build to provide more supply, but it may actually take people out of the market and they may go elsewhere. In fact, in their own modelling, they said that it's going to contract new construction by about 35,000 homes. But there's logic in that is that that's okay as long as we then get more than 35,000 investors out of the market, which then provides those properties to first home buyers. Therefore, it's going to be a net gain nationally. Yeah, this is all based on national data. Yeah. So, some of the commentary has been about that's going to put pressure on rents, possibly. With all this, I love speculation, but I hate speculation. If it gets up, the only way we're going to see whether this works or not is proof in the pudding and basically making it happen and then monitoring what the outcome is. So we can do all this wonderful modelling and speculation. I've got some modelling as well we're going to do as well, but at the end of the day, the proof in the pudding is what the actual outcome will be. And then obviously for Victoria, and this is where we've got increase in land taxes and things like that are quite substantial now. We've got to take that into consideration in terms of our investment strategies and what we do with property going forward. So that's it on negative gearing based on what they're proposing. Now, there's so many elements to it. As I said, if you have an existing house and then just demolish it and then build another one, or if you've got an existing house and then you start renting it out when it was a principal residence, now it's not. All these things, there's speculation about what it is, and there's readings which you can say. For instance, if you have an existing property and then you rent it out after this date now, and it's your principal residence, you rent it out, that's okay apparently, but don't fully know until we see the legislation. Next one, CGT, capital gains tax. So currently, individuals and trusts get a 50% discount if you hold an asset for greater than 12 months and then you sell it. So give an example, you hold a property, you pay property 500,000, you bought it whenever it was, you then sell it for $1 million, you've got a $500,000 capital gain. If you've held it for more than 12 months, you halve the gain, so you only pay tax on $250,000 of the capital gain. That's for individuals and trusts. For companies, that 50% discount does not apply and never has. So companies are different. It does this rule, these changes do not apply to self-managed super funds either. Super funds are excluded from these rules. So it's only to do with individuals and trusts where this impact is. So under the change, so again, this one is from 1 July 2027. So in a little while's time, so what we've got 14 months, the 50% discount will be replaced with indexation of the cost base. This is what we used to have before 1990. And when the Howard government came in, they basically brought this 50% discount in and abolished the indexation. So now we're reverting back to that old indexation method. And then based on whatever the gain might be, there would then be a minimum tax of 30% that would apply to capital gains. So a minimum. So they're saying a baseline. So it doesn't matter if your marginal tax rate is 0 because you've got no other income. It doesn't matter if your tax rate is 15% or whatever it might be. The minimum will be 30% on the capital gains. Then if your marginal tax rate is higher than that, then you'll pay whatever your marginal tax rate is, allowing for the indexation. Investors in new builds, though, will be able to choose between the current method of 50% discount or the indexation. So they'll have the choice. And we actually had that between 1999 and 2000. And Paul, do you know, can you remember? Sorry, I'm not picking on you based on you being similar vintage, but they had the option at one where you could actually choose between which method gave you the best result for a period of time between 1999, I think it was about 2003 or something like that. And then they removed the indexation completely. But the key thing with this is that, yes, this is coming in from 1st of July 2027. So what does that look like? Because it's not as simple as that, because it depends on if you sell the asset before or after that date, because you still get the 50% discount up until 30 June 2027. And then you have to get a valuation of the property at that point to then strike what the value of the property is, to then apply the indexation to that portion of the property going forward. Would that be a sworn value? Good question. Don't know yet whether it's going to be a sworn valuation or not. Yeah, I think to be robust, it would be nice to have that, but that's going to probably be a lower valuation than what you need. What the ATO says for other purposes of valuation, it's got to be by someone who's licensed, a licensed real estate agent who can provide valuations. And they've got to do comparable sales and have some justification for it. They can't just give you that one-page letter saying, oh, we think the property is worth this much. It's got to have some basis for it, and they've got to be licensed to provide valuations. But whether that's a formal sworn valuation, not necessary, I don't believe. But again, let's wait and see what the detail is. What the ATO said too, though, is they're going to come up with some wonderful formula that you can use so you don't have to get a valuation. So they're going to say, here's our model, you pluck your numbers in, and then it'll spit out what the pre 30 June 2027 figure is and what and so therefore we can work out how we calculate the gain. So they're going to give us some sort of model for that. Be interested to see how complicated or otherwise that is. And you'll be able to choose between the two methods to work out which one will give you the best result. So it might be prudent, unless it's a small gain, to get that valuation so you can then compare, but you may not use that because you might then go back to the HO model that they're going to prepare. So how does this look like? Bear with me on this one. We're going to do this interactive. So I'm going to get people to throw some numbers at me and I'm going to show you my wonderful spreadsheet to see how this looks. So let's go into the CGT scenario model. So who wants to give me a date of when they purchased property? You can give your own example if you want to, and we can throw it in and see what it looks like if you've got in your head what date you bought a property for, because the dates and the purchase price and all that is really relevant. If you're not, I can throw some numbers in. But anyone want to give me a date? We'll throw in. Let's do 01, 07. Let's say 2020. So we've had the asset since then. So we've had it for nearly 6 years. Purchase price. Anyone want to give me a number? Throw a number at me. Doesn't really matter. 1.5 million. Okay, done. Thanks, Sharon. So let's speculate what the market value might be at 30 June next year. So we bought it for 1.5 back in 2020. What figure anyone want to pluck a figure what we reckon it might be worth? And we can change these numbers. 2.8. Wow, that's good growth. I need to buy property off you, Sharon. I need you. Sorry, not buy it off you. I need to get your investment advice. Yeah. And when do we want to sell this property? So 30 June is that transition date. So let's say we sell it. We can go to 2032. Anyone want to pick a date? Thank you. And how much did we sell it for? Or how much are we going to sell it for? What do you reckon the number might be? We're assuming, but based on these new policies, it might go backwards. Inflation rates, because this is really important, because this indexation that they're going to apply is based on inflation. So at the moment it's running at 4.6. On average, it runs around 3 to 3.5%. So what number do we want to throw in there? And we can change this number. You can see how it changes. 3.5. Okay. And then what tax rate are we going to pay it on? Now we've got a pretty big gain here. So most likely I reckon that's going to be at 47. All right. So let's do 47. Right. And you'll see that's the minimum, 30%. Okay. So based on all that, you know what? It's going to be cheaper under the new rules. You're going to pay less tax under the new rules than what you do under the old rules. Where's this hysteria? So you read the Herald Sun. I'm going to say it. You read the Herald Sun. The world's going to cave in. Albo's now 47% shareholder of everyone's properties and everyone's business. Under this scenario, now there's scenarios that go the other way, but tax saving 20,000. You're going to pay $20,000 less tax in that scenario versus what the current rules are. We can change that. But did anyone think that? Did you everyone think that that could be possible? So what happens if you've got a pre-1985 asset, it is brought into this system on 30 June 2027. So you will start paying capital gains tax on any asset you bought pre-1985 on the growth of the asset post 30 June 2027. Yeah, so that's a big change too. Let's change the inflation rate and see how that impacts it. Now, all these things, if we change any of these fields, it's going to give a different number, but let's do the inflation rate at what number? 5.5? Gosh, you know why it's better? Because the indexation, the compounding effect of indexation, you're better off now by 133,000 under the new rules versus the old rules. Let's go back to 3% on inflation. Now you're worse off. This just shows you that we've got to take it on an asset by asset basis. We can't just make this general assumption that, oh, the world's falling in and we're going to pay all this additional tax because of these changes. There'll be winners and there'll be losers, as always is the case. The losers will be those people who are on lower income who are not paying that 47% tax on the gains. So if we change the tax rate, and I'm not sure, I haven't done all these modelings, but let's throw it around. Let's say their tax rate is 32%, including Medicare, still moderately different. So very minor. It all comes down to the size of the gain, timing of the gain, how long you've held the property for, before and after 30 June 27. But that's just one example of where you're not worse off, or very moderately worse off if we've got the inflation at 3%, but anything above 3% in that scenario, so let's go back to that 3.5, you're now in front because of the indexation. So what happens? So in effect, the way that used to work pre-1999, I'm going back a long way to try and remember it, they basically published the inflation rate every quarter, and they basically started at 100, and then they went to 101 point something, 102, 103, so they just kept adding to it. And so so what I'm assuming they'll have is at 30 June 2027, they'll have 1 as the base, and then they'll just accumulate every inflation per quarter onto that, and it'll just keep summing up on it. Whether it compounds or not, it'll just keep adding to it. So again, this is just my model, and I haven't interrogated it to the nth degree, but just to give us a general idea about it, because this is just general example, the inflation rate does have a big impact at it. So in theory, the 50% discount is 50 points of inflation. So it comes down to how long, and also the valuation in this case, but how long you've held the property for, how much that inflation goes up compared to what the 50% discount would have been. So there is some ways in which you could probably work that out, but there's so many variables, it's really hard to give a benchmark on it in any particular way. So it's per asset, it's based on the circumstances for you and that asset. Because obviously too, if I change any of the other fields, such as we only held that, let's say that market value was only 2.4 million or 2.1 million or 2.2, I'll do 2.2. Make sure I put enough zeros in it. Now we're worse off by 100,000. So you can see how the impact of the market valuation at 30 June 27 can have a massive impact, how inflation can have an impact, and then how long you've held the property and what the capital growth is. So there'll be winners and losers is the short answer, right? But I just thought it was a cool exercise to do. Maybe I'm getting too excited about it, but cool exercise to do to show that it's not all doom and gloom. It may not all be doom and gloom. There might be some situations where you might be better off. So let's keep going. This one. Oh, wow. I think this is the biggest one out of all of them, and particularly for business owners, because most of our clients would have trusts of some form because they're great for asset protection. And I'll give a commentary on that in a minute. But the proposals for trusts, and this is more so discretionary trusts, and that's a really important distinction. A fixed trust is not included in these proposals, but discretionary testamentary trust, which there's been a lot in the media in the last few days about that. Anything that's got any discretionary elements in it, and I'll cover that in a second. But from 1 July 2028, so a year later than the capital gains tax and negative gearing, discretionary trusts will be subject to a minimum 30% tax rate on income. So at the moment, trusts don't pay tax in their own right unless you don't distribute the income to the beneficiaries. So what happens normally? You have a trust with the amount of income. It will then year end say, okay, I'm going to distribute the money out to these beneficiaries, which could be individuals, could be another trust, or could be a company. And then it's subject to what the tax rate is for that person who's the beneficiary, or that company that's beneficiary, that dictates what tax is paid. What they're saying under these proposals now is no, before you do that, it doesn't matter what you do for the distribution point of view, the trust itself is going to pay tax at 30%. So that's your minimum baseline. And then whoever you distribute to, if they're on a lower rate than 30, that does not matter. They're not going to get a credit for that. They're still got a baseline is going to be 30% tax. So if you distribute to a child who's 18 and not working, and we can allocate them 20,000 tax free, that's gone. It means that they won't get a credit for that tax paid. So it just means that benefit of getting that lower tax rate will be gone after this. With companies, and I'll come back to that in a second, there's some major impacts for beneficiary companies as well. Now, the key thing with this is because they know this is having a major impact on small business and investors who are holding trusts, which, by the way, is only about 5% of the population, supposedly, is based on their modelling. They're going to offer this rollover relief where you can reorganise your affairs to be able to move out of a trust if you want to. So you're not going to be impacted by these new rules. And they're giving you a window between 1 July 2027 and 30 June 2030. So they're giving you a 3-year window to be able to do that. What that looks like, do not know. That's just a headline. They haven't gone into a lot of detail with it, but it'll certainly allow you to move assets or move shareholdings or in in companies or other where they're held by trusts. It'll allow you to move those across to another entity, whether it's individual or whatever it might be, but we just don't know the detail on that one yet. So we'll let you know. But there is actually a couple of rollovers that are available already, and we might be able to utilise those too. So the potential outcomes is it may reduce the tax effectiveness of income splitting through trusts. So we got all the investment income, you say, okay, this year I'm going to allocate it to this person and this person, then next year I'm going to change it, and I'm going to split it between taxpayers so we get a lower tax rate. So it's going to compromise that. And it could increase the effective tax rate for investors, like that example where if you distribute to a child, no longer get that tax-free, it's going to be taxed at 30%. So there's going to be some additional tax in that. And it's likely to impact family trusts. So discretionary trusts are what we call family trusts, non-fixed unit trusts. And this is a really interesting one. We have what we call a fixed or a unit trust, and we think, oh, that's fixed entitlement, so therefore it's not discretionary. You've got to read the trust deed, because a trust deed may have discretionary elements to it, even though we've been applying a fixed amount to the unit holders in that unit trust each year. So this is where the unit trust deed becomes critical to work out whether it is covered under the discretionary trust rules for these changes, or whether it's a fixed trust and therefore exempt from these rules. And part of this process will be you will be allowed to, I'm guessing, reword or amend the deed to make it a fixed trust if that suits your circumstances. The key details outstanding is still actually working out which trusts are impacted. The other one is discretionary testamentary trusts, and I'll cover that in a bit more detail in a second once we get through this slide. They're going to be impacted too based on the reading of the proposal. And there could be further exemptions, and we still need to see obviously the legislation. So in the meantime, you just want to review your structure, review your distribution strategies, but it's okay until 1 July 2028. Future asset purchases, so if you're looking at buying an asset now, whether property, shares or whatever else, is the family trust the right vehicle for that? And again, that's where you need to consult your advisor at Aintree Group or whoever it might be to ensure that we're covering off on all the bases. But the challenge with that is we don't know what the law is. So is it status quo or is it something different? Because we don't want to react to these things and then find out that it's going to be changed, watered down, not get up at all. Who knows? Now, is this the end of family trusts? Does anyone think this is the end of family trusts? No, I disagree if you think so. Why not? Anyone want to give me some guidance on why you think family trust still might have some benefit? Asset protection, spot on. Do we do things always just for tax purposes? No, no. So in my very professional language, yes, this sucks, but you've got to weigh up the asset protection that family trusts provide versus the additional tax you pay. So give you an example of me personally, and I talked to Alan about this before. I've got a family trust. We've got assets in it. We've got our share in Aintree Group. Andrew and I's share in Aintree Group is through our family trust. If we thought, oh, this is a disaster, I'm going to get that investment in Aintree Group out of there and into my personal name, that creates two issues for me. One is that it means I've got an asset in my personal name. So if I get sued, if I give negligent advice and I get sued, then all my assets are in trouble because they're in my name. So do I want that? Am I prepared to pay a bit more tax for the benefit of having that asset protection? And for me, the answer is yes. Yes, this sucks and I'm going to have to pay more tax, and I will have to pay more tax like other people who've got trusts, but that is a more important issue for me than paying the extra tax. I think I can afford it. Not that I want to pay it because I hate paying tax like everyone else, but I can afford it. So it's all about not just looking at this purely from as being tax driven. Yes, we've got to manage that and try and minimize it as much as we can, but asset protection, that is what the whole intentions of family trusts were for, is for asset protection. Because the alternative is a discretionary trust, you don't have control of the asset for asset protection purposes. It is owned by the trust and not by you personally because it's got discretionary elements. You don't have a fixed interest in it. As soon as you move to a fixed interest, then that asset is yours and therefore it's exposed to risk if you're a business owner or whatever it might be, or you do something negligent and you get sued personally, then those assets are potentially attacked. And for me, I don't want to work all my life and build up all these assets and then have that exposed than me making one silly mistake in some way where I get sued personally. So that's my personal opinion and my personal circumstance. With others, everyone's prerogative, but I still think they have a place, even though we've got this tax issue now that we have to contend with. So this what it means is this will still come in from 1st of July 2028. So you'll still have to apply these rules on that day. They give you 3 years. So ideally, you want to try and get it done in the first year if you can. But if you can't, then you've still got 2 years. But you'll still have to apply these rules until such time you restructure it out. So yeah, so if you haven't done it, these rules will apply to you. You don't get a grace period from it because you say, oh look, yes, I'm gonna nominate, I'm gonna restructure. You've actually got to do it before you come out of these rules. Yeah. So so ideally, it'd be between 1 July 27 and 30 June 28 if you're going to do something before it kicks in, if that's what you want to do. The reason they're doing that is because this is going to create a lot of work. And jokingly, it's an accountant's picnic. Yep. Because who are you going to come to for the restructuring? It's us. And we might not have enough hours in a day doing our current work, plus all this restructuring, if that's what's going to happen. And that's why we need, so thank you, government, we need 3 years to be able to get through all that. Now, this one's a little bit more complicated, so bear with me and apologies if we get stuck on it. So here's my trust distribution tax scenario tool. So I've just got in there 100,000 worth of income, and I've got the minimum tax rate, because I haven't told you about corporate beneficiaries yet. I want to do this modeling, then you can see the impact of it. So we've got 100,000 worth of income. Minimum tax rate in trust now is 30%, and the company tax rate is 30%. Now, company tax rate can be 25 or 30%, but when it's a beneficiary company, generally 99% of the time, it'll be taxed at 30%, not 25. 25 is more geared towards business companies running a business. Here are the individual tax rates for the 2028 year and beyond. And the key one that's different to what it is at the moment is, and it's a really small concession, but 14% is a tax rate up to 45,000, between 18,200 and 45,000. And then you can see 30% up to 135, 37 up to 190, and then over 190 we've got 45% plus Medicare. I've taken Medicare out of this one because it just made my calculator too hard. So I'm just being honest with it. So in theory, put in your mind, you can probably add another 2% to it. So we've got different beneficiaries, and this is the joys of trust. We can pick and choose who we want to allocate money to each year. So I've just got an exercise where I've got child, testamentary trust, and I'll come back to that. Adult 1, 2, 3, 4, and then beneficiary company. What I've done deliberately is I've put the other taxable income as being the marginal tax rates, where those brackets just above kick in, so we can see the impact for different people. So we've got adult 1 who's got no income at all, and let's see what the impact of giving the money to that person might be. Then we've got adult 2, where we've got 18,000, 45, and 135, which is, as I said, all those. I didn't go the 47% one, 190 because it's pretty clear. So let's start with, let's say we've got 100,000 worth of income. We're going to allocate 100% of that to the person who, taxpayer number 1, adult number 1, got no other income. And I'm going to cut through all this. The difference in tax now, you're going to pay $9,212 in more tax based on that $100,000 income being allocated to a person who's got zero tax bracket, because current law, 20,780, new laws, 30,000, that 30% baseline. So 9,200, that's a sizable amount. Let's change it to go to, and I'm just doing this 100%, but when we can do all different machinations of this with different percentages, different people, let's go to the next person and do 100% to that one. What's the impact? It's now down to 3,750. So if they've got 18,200 worth of other income already, and we allocate that to them, then the impact is lower. Let's go to the next one, which is the 45 bracket one. We're leading up to the big one. So this is the next one. And the additional tax in this scenario is 4,200. I got the other one wrong. Actually, that didn't work, the other one. I need to check that. Sorry, let me go back to the previous one. I was on the wrong screen, I think. Because of all these tools. I'll lead you in a little secret. Copilot is a wonderful thing for these things, creating these. Yeah, I might be having a bit of a calculation error on that one. I'll keep going. But you can see that the tax benefit, once you get to that tax bracket of 45,000 worth of other income, it's minor. I'm going to put the company one in now, and you can have a look at that one. Let's put 100%. So this is a beneficiary company getting 100,000 distribution. Have a look at the difference. $30,000 in difference on 100,000 worth of income. Beneficiary companies get taxed twice under the rules, proposed rules. So the trust pays tax at 30%. When it gets distributed to the company, they don't get a credit for that 30%. They have to pay that 30% again. So it's an effective tax rate of 60. Does anyone want to do that? I don't know whether asset protection gives me enough. I don't think that's palatable enough for me even to say trust to company is a worthwhile thing for tax purposes and get my asset protection. So that's ouch. So the effective tax rate is 60% on distribution to the company. So in effect, bucket companies, when these rules come in, I think they're done. Unless there's some compelling reason why you want to pay 60% tax, because then the other part is when you then pay that dividend out to get it out to the beneficiary, there's potentially another 17% top-up tax on top of that. So therefore it gets to 77% effective tax rate or something like that. Not very palatable. So Companies are the biggest issue. So what it means ultimately, though, is that instead of putting it to that bucket company where you get cap it at 30% for the moment, and then potentially manage that down the track under Division 7A, what it might be, that income really needs to go to individuals now that otherwise wouldn't. So you're going to be pushing people into higher tax brackets. It's really interesting because it means that we're going to have a situation where, even though my modelling gives you a certain amount, it's actually potentially going to be more than that because we're paying 47% tax on income that we otherwise might have capped at 30% or some lower rate. So this one is the big one. So that's where you've got to work out the competing interests here. Am I going to save tax or do I want asset protection? There's no right or wrong answer. It's about your circumstances and what's important to you to work out how this one's going to play out for you. So this is the thing. So most testamentary trusts, pretty much all the ones I've seen, are discretionary testamentary trusts. Really? Yeah. Because again, the reason for a testamentary trust is mainly for asset protection, to protect the person who's entitled to that money so that it's in trust for them, to control that for them, to make sure that it's following the wishes of the person who's passed away, to apply that to that person appropriately. So they have got that discretionary element for the trustees. So this is where we flip around to, okay, if we then go down the path of creating fixed discretionary trusts, it means that that child, as soon as they turn 18, if it's for a minor, they put their hand up and say, I want my money. They've got an obligation to receive it. Yep. So the asset protection has gone out the window. Yeah. But again, and I'll again go through the commentary. They're saying this is a new death tax on testamentary trust, the 30% that's been in the commentary. That's bullshit. It's rubbish. Testamentary trusts get taxed anyway. So there's nothing different. It's just that the rate is higher than what it is. Because at the moment, if you're under 18 and you're a beneficiary of a testamentary trust and income is allocated to you, you get adult rates for tax purposes. Testamentary trusts have got this unique element to them that, because they're created on death, that anyone under 18 can be treated as an adult for tax purposes. If you're treated as a minor in a family trust, the maximum distribution you get each year is $416 before you pay the top marginal rate of tax. Whereas under a testamentary trust, you get all these wonderful brackets that I had up the top here. You get the benefit of all these different rates. So you can give the first 20,000 to them, or 18,200 tax free. Next amount is only taxed at 14%, etc., etc. Under these new rules, we're going to be applied the same as what it is for the adults. It's going to be exactly the same, where minimum trust rate will be 30%. And if your personal tax rate is lower than that for the beneficiary receiving that distribution, you will not get a credit for that. It's that baseline 30. So again, testamentary trust is all this hysteria. They are still a relevant tool for controlling the assets and making sure they're applied appropriately for the beneficiaries of your estate. So I would not be trying to look at making them fixed, because, as I said, as soon as someone turns 18, they're legally entitled to the if they've got a fixed interest, they're legally entitled to the assets of that trust. They've got a duty. The trustees have a duty to disclose. Yes.
Has the modelling been done on how much?
I don't know numbers on that. No, I don't. It's, again, testamentary trusts are very popular for high net worth people, because they've got a pool of assets and they might not want that to go to their children when they turn 18 if they pass, because then they might go and they're not responsible enough at that age to deal with those assets themselves personally. Other clients will say, don't care, they can do whatever they like, I'm dead, I don't care, and therefore have it if they want at 18. So in that case, we might do a fixed testamentary trust, or we might not even bother with a testamentary trust. It might not be necessary unless they're under 18 still. Yeah, simple rule. Yeah. So this one's a really interesting one, and but the notion that this is a new death tax, the way it works with a testamentary trust, on your death, your assets transfer into the testamentary trust. There's no taxing point at that point, because the assets retain their original character, so they don't get taxed as soon as it goes into testamentary trust. It's only the earnings on the assets that get taxed, and then when you eventually sell that asset, then you've got the taxing point then when you sell that asset, not when it's transferred in, it's when it's sold. So this notion of this new death tax, I think it's a higher tax, but it's not a new death tax. Yeah. So I'm just trying to get rid of some of the myths or some of the rubbish banter that's going out there. But yes, it's still a negative outcome compared to what it is now, but that's how it's going to work. Fun, isn't it? Any more questions on any of that? Because that's the bulk of it, and then we'll probably whiz through the rest of it quite quickly. No, self-managed super funds are not deemed to be a discretionary trust because they've got fixed member entitlements, and they're expressly excluded from this. And similarly, they're excluded from the new capital gains tax rules as well, which I might have mentioned before. So they still get a 1/3 discount on capital gains when they sell. Doesn't matter whether it's pre or post 30 June 2027. So the same rules apply for superannuation. There is another tax in super, which we'll cover in a minute, for high member balances, which comes in from 1 July. But we'll talk about payday super quickly. This is just mainly for business owners. Payday super comes in from 1 July. So at the moment, if you're a business owner and you employ people, you generally have a minimum requirement to pay your superannuation on behalf of your employees every quarter. So you get 28 days after the end of the quarter to ensure that payment is made and into the employee superannuation fund. From 1 July 2026, that's changing because they can do it, as the name suggests, payday super. Whenever you do a pay run, the super will be applicable at the same time. So you can't hold that money for three months or whatever it might be. It's got to be paid within 7 days. So you do it when you process the pay, but it's got to be processed at the same time as when the pays are done. So that's going to be a cash flow impact for particularly small business. I do have concerns for retail and hospitality because they're going to really hurt because this is bringing forward their cash flow that they may be struggling with already. So this is this challenge. So let's say you've missed, so you do your payroll fortnightly, and you've missed 3 fortnights worth of pays. I've missed 3 fortnights worth of super, and then you pay the next one. It's first in, first out. So they apply that back to the first one. So therefore, that next one you've done will be late too. You've got to do the whole catch up to be able to get back on track. Otherwise, they're all going to keep. You can't say, "Oh, look, I'm late on those 2 there, but I'll keep paying them in future now, and I'll catch up those later," because they apply it to the first one first. So you're always going to be late. Yep. Yeah, that's exactly. That's a great analogy. I'm going to use that if you don't mind, Sonny. Yeah, that's a great analogy. You've got to clear the debt, otherwise it creates an issue perpetually. So that's something to be really aware of. So the key thing with that is you've got to. I will say it. We're recording, but I'll say it. If you're struggling cash flow wise for paying business expense or taxes, the first one you've got to pay is this one. Do that first before PAYG, GST, PAYG instalments for income tax. This is the first one you need to pay because this has the biggest consequence from a tax point of view. There is a massive amount of unpaid superannuation out in the market, out in the economy. Yeah, it is unknown. Yeah, they just can't afford it, cash flow wise. Mainly, they can't. Their business is not supporting them enough. Like it might be lifestyle that's causing it. But yes, a lot of delinquent employers because their business might be earning this much. They're requiring to live, mortgages and other commitments they might have that's higher than that, and therefore they're not saving enough within the business to be able to then pay that superannuation.
And a lot of the employees wouldn't know that,
they assume, but this is where you've got to be diligent and look at your superannuation balance regularly to see whether they're paying it. Now, what's happening with this too, and it's becoming more transparent now too, because we've got in a regime now called single touch payroll, where when you process your wages, you must report that to the ATO and to the superannuation fund. And when this kicks in, it's going to be even more transparent because all the software providers who do the payroll for you, they've got that, it's all going to be built into the software. So everyone's going to know more, and so the ATO is going to know this very quickly if you haven't paid. That's being abolished. So on 30 June, that's being abolished. They're going to force people to use payroll providers. And so part of whoever you process your payroll through, you're going to have to use them for the superannuation. Yeah.
But surely, if you believe, many businesses do have genuine cash flow.
That's right. Yep, it is. This one is. We're going to see a lot of problems with this one. I'm absolutely confident of it. Yeah, correct. Yep. Yeah, sorry. Yes, I'm being vague. Yes, businesses will go under. Yep. Yeah. But that's great. But sometimes some businesses might be cyclical and there might be peaks and troughs, and we're going into a difficult economy. Yep, that's right. Yep. Yeah. This one is a sleeper, and I think we're going to see a big impact on this in the next 6 to 12 months. Yeah. That's if you want the tax deduction in this financial year. No. Technically, again, this is where the legislation is. I wish they'd change this. It's got to hit the fund of the employee. So give you an example. So in the situation where it's quarterly at the moment, we've got one coming up next week. Is what? No, what month? No, it's not. So let's say the March quarter was due 28th of April. If you paid on the 28th of April, then that's non-deductible and you've not complied because it hasn't been received by the super fund by the 28th. So what we're telling clients is you've got to leave at least 7 days for it to go through the clearinghouse or the software providers, and I'm being cynical, they keep the money for a couple of days just to make some interest on it before it then goes. So you've got to be mindful of that. You've got to not pay it on the day. You've got to give plenty of time. And particularly when you're getting to close to 30 June, if you want that tax deduction, which I was going to talk about later, and get that deduction before 30 June, the software providers and everyone's recommending you pay it by the 15th of June. It needs 2 weeks for that money to go from your account and to hit the super fund of the member because there's such a volume of transactions that occur.
The amount's going to be minimal.
It will be smaller, yeah. But we've got some clients where they might have EBAs where they're paying some employees weekly and they've got others fortnightly. And so they're going to have 52 pay cycles for some of their employees. And they're going to have 26 pay cycles for others. It's in theory, it's meant to be just pressing a button and then you get a text with a code. You type that code in, and then Shazam, the money gets processed through the software provider. So it's meant to be pretty easy. Just got to make sure the money's there. I don't think many. Yeah, no, I don't think many. So
We see that.
yes. I still shake my head about how it takes so long. It's got to change because I can transfer money to you, George, tonight. I get your mobile phone number and do it, and within a minute you've got it. Why can't the same apply to here?
Too many questions.
Correct.
My city. Well, just to finish on that, that OSCO arrangement where it goes instant was meant to happen for all transactions across the economy. And then the banking lobby said, "Oh, we're not ready yet," and so they've deferred it. But that would have fixed some of this too. This would have meant this would happen. But and again, being cynical, it's because they get to hold the money for a couple of days. And you think about with the volume of superannuations processed every quarter or whatever, there's a decent amount of money they can make out of it. Yep. The other key thing is they're changing the definition of what superannuation is paid on too. So it used to be on what's called ordinary time earnings. Now it's on what's called qualifying earnings, and they're both mostly the same. The main one that isn't covered is overtime. Is generally not covered, but any allowances you pay are covered. And also the other one is contractors. So this is a change in the definition. So contractors, if they're deemed to be an employee, they're covered under this too. So if you're paying a contractor, you've got 7 days to pay that for them as well. And if you don't pay the super on that contractor, so if you get that wrong, if you define, oh, look, this contractor is not subject to superannuation because I don't believe they are because they're an independent contractor, but then the ATO comes back and says, no, they are a deemed employee, you should have paid superannuation on it, then all that superannuation is late.
If that contractor gives you a tax invoice to do that work,
Doesn't matter. Yeah. Again, this is another session for an hour on this one alone. Yeah, if they're a sole trader, there's a good chance they're going to be an employee if you keep giving them repeat work. If they're through a company, there's ways around it. Yeah, but you've got to test what structure they've got, and sole traders is the real danger. But even companies and so on, you've got to dot the I's and cross the T's. Yep.
Shane, with the qualifying earnings,
Yep.
that's the change.
Yep.
Yeah. So that's ordinary time earnings plus
Contract.
For example, say car expense.
No, if the allowance is deductible in full, if you think you can deduct the allowance in full, then that won't be subject to it. But if you're providing a meal allowance or something like that, which is arbitrary, then the answer is that will be subject to superannuation as well.
Oh, really?
Yeah. It still was, but it wasn't. They're being more explicit in the definition now than what they were previously. So they're making it. So the answer is it still was. Yeah.
So, say for example, salary, and then there's allowance.
Yep, that's correct. Division 296. Now, this applies to superannuation funds where the member balance per member is more than 3 million. Okay, so it supposedly only impacts 85,000 Australians. So if you're in that category, congratulations, you're in the top 85,000 superannuation fund balances in the country. And what it does is it adds an additional tax to superannuation that isn't there at the moment. And this comes in from 1 July this year, so in a month and a bit's time. I'm going to quickly go through this, and I've got a little model for this one as well. But basically what it's designed to do is there's created brackets like marginal tax brackets for your in personal income tax. So they've got now a bracket between 3 and 10 mil per member, and then a balance above 10 mil. So between 3 and 10, you can potentially pay another 15% tax on your superannuation. And then if your member balance is above 10 million, then you can pay another 10%. So effective rate of 40% potentially on the portion above that. So it's only on their portions. So the first 3 mil, it's just 15% if you're in the accumulation phase. If you're in the 3 to 10 mil, the portion between 3 and 10 at 15%, and then the portion above 10 mil, another 10%. So effective 15, 15, 10, 40%. When this was proposed, they were talking about doing market values, bringing unrealised gains to it. That's all gone. So it's far more simple now. But then this comment about, oh, you're going to pay 30% tax on your super balance if you've got over 3 mil, that's rubbish as well. And I'll give you an example, and I'll give you quite an extreme example. This is a real life example of one of our clients. I'm not putting their name on it, but I'll show you what this looks like. So we've got a client, whoops, wrong one. So we've got a client where there's 2 members in the fund. I've just rounded the numbers, but they've got roughly $19 million in their superannuation fund between them. So $9,500 balance each. And their earnings last year was not $650,000 on their super fund. So that's dividends, rental property income, interest income, etc., etc. When we calculate this new Division 296 tax, we have to make adjustments for pension exempt income and everything. So when we apply the balance and the calculation, I'm not going into all the detail, we had adjusted taxable income for Division 296, this new tax, of $893,000. And so they have to pay tax on that based on the portion of their fund above 3 million, between 3 and 10 mil. And what that came in at, that's going to mean they're going to pay, under this new rule, if it kicks in, another $91,000 in tax. Now, is that 15%? No, it's about 14.1 because they're right up near that that threshold. If their and I'll show you what it looks like if their MEM balance is lower. But the other important thing is we look at that in the context of that plus then what their income tax is on the fund normally. This client had lots of dividends and franking credits. So their effective tax rate on 650,000 worth of income was negative 2.3 because they were getting a refund of the franking credits from BHP and all those different shares. So they actually had a net refund of $15,000 on their fund. So when you add the two taxes together, their effective tax rate on 650,000 worth of earnings was 11.8. So this hysteria that I'm paying 30 on
This is a self-managed sort of.
self-managed fund, but it applies to industry funds as well. Some differences in it, but in effect, it applies the same way. So what I'm getting at is that, yes, it's on the number-wise, it's a big number, but when you look at it as a percentage, where can you get a tax rate of that outside of superannuation? Tell me if you got one, because I don't have one, not for that sort of income. So again, these notions that, oh, we've got to do something, we've got a member balance over 3 million, we've got to do something about it so we're going to avoid that tax. That asset or those assets have to come out and they have to go somewhere. And based on the trust proposals, based on the capital gains tax proposals outside of super, where are you going to get a return like that? A tax rate like that? You're not going to. So even when you've got balances, quite substantial, depending on the asset mix within the fund, superannuation is still a low tax vehicle and is probably the best one out there for most people in terms of accumulating wealth and minimising tax.
So the model is to invest in equity
Franking credits at the moment, because that's the one I thought they were going to have a go at again, because they tried that back in 2019 where they didn't give refund of excess franking credits. But at the moment, yes, because what happens is the tax rate in the super fund ordinarily is 15, but when BHP pays your dividend, that's at 30%. You get the refund of the difference. So you're getting get tax back that you didn't pay. You're getting tax back that someone else paid. Yep.
So you think this budget with the bucket company, that's the first attack on franking credits. Next budget,
I thought they would have gone for this one if they were going for something, but yeah. So yes, it could be next. It could be next time. Who knows? Let's wait and see. I think this one is a Monty to change, because even though I'm here to advise clients get the best out for clients, that's just too generous. That's my opinion. That's too generous. The fact that you can get tax refunds of tax you haven't paid just defies logic to me, but it's there and we take advantage of it because we can until they change the laws. But this one was on the radar 2019. It'll come back at some point. So I agree with you. It'll come back at some point, whether it's next year or not. Depends on the political climate, doesn't it? So we'll wait and see. So there's an example. But if I show you a situation where let's drop the let's put this up to, let's go extreme on this, do $15 million each, and let's put that at, let's say, what's 30 million to 5%? Let's say 1.5 million. Let's just take these two out just because they're not. So so if you're in retirement phase, then when you start a pension, the portion of your fund that's in pension phase, the earnings on that is tax free, so you pay no tax. Yeah. So the effective tax rate is zero, and generally for most people, the threshold for that is about $2 million, but it depends on when you started it. But generally, if you've done it correctly and the timing's right, then around $2 million, if you're doing it today, 2.1 million is what you can put into pension phase, and that part of it becomes, the earnings on that part becomes tax free. Yeah, I've got 15 million, 30 million, we're getting 1.5 return. Let's take that one out for the moment. But again, you'll see that even on 15 million, it's still not disastrous. It's only 15.33% additional tax. Again, even if we've got 15% on this bracket here, tell me where you're going to get, on a return of 1.5 million, tell me where you're going to get a 30% tax rate, unless it's in a company. But then when that comes out, there's potentially top-up tax as well for the dividend. So I've done all sorts of modelling on this, and I can't find a spot until you get up into the extremes of about 25 million plus per member that there's a compelling reason to look at bringing assets out of the fund. But that's just on the modelling I've done. Bring assets out of the fund and invest them somewhere else to get a better rate. Yep. Right. So that's Division 296. How are we going for time? We should speed it up now. Yes. Copilot's really good. You still got to know what you're doing, but it helps me to build it quicker than me trying to do all the formulas and everything myself. Yeah. So I've done that. Instant asset rise. So finally, hallelujah for me, but maybe not for you guys, and the accounts in the room will be delighted with this too. Finally, they've legislated that you get the instant asset write-off. So this $20,000 deduction. So if you buy an asset for less than 20,000, you get a tax deduction for it immediately. So you don't depreciate it over its life. You get it straight up. This particular legislation or piece of tax benefit, they've had to go to Parliament and put this in every year. So they've had to go to Parliament and debate it to then get it through every year. And last year, we didn't know whether it was actually in place for last year until about 45 days to go in the financial year. So it made planning ridiculous. And we've been saying, why don't you just legislate it one and for all and set it in stone? They're finally going to do that. So we know going forward. Now, whether the threshold's the right number or not, That's debatable, but they're now saying that we don't need to worry about this uncertainty of trying to work out whether they can get it through Parliament every year. It's now going to be legislated so that permanently from 1 July 2026, which is just coming up, this is going to be a given, that we've got that available to us. The key thing with it is that you can buy, you've got to be installed ready for use. So if you buy an asset today and you want to claim the tax deduction for 20,000 or less this year, if its delivery is in July, you won't get the tax deduction for it. It's got to be received and ready for use in your business in some way. So if you buy that laptop or whatever it might be, and they said, look, we don't expect delivery until July, then you're going to miss out. So again, you don't leave it to the last minute unless you can go to JB Hi-Fi or something and buy it, physically grab the thing and then use it. The key thing here is really important. So if you're registered for GST, it's the GST exclusive price. So you take the GST out of it. But if you're not registered for GST, it's a GST inclusive price. So the same asset can have different treatment. If it's $21,000, if you're registered for GST and you can claim that GST back, you'll qualify. But if you're not registered for GST and you buy that 21,000 asset, you won't qualify. The joys of the rules. And building and structural improvements are not generally don't qualify. It's got to be a freestanding asset in effect. It can't be I'm going to mount a cabinet on a wall or anything like that. That will not qualify. It's got to be something like this: a chair, display monitor, TV. No, not TV. A display monitor for your office. Yeah, absolutely. But it's not something that's fixed to the wall. That's structural. That's fine, and that's okay. But it's removable. But it's not something like a cabinet that you can't move around. FBT on motor vehicles. So ATO is having an absolute field day with FBT at the moment. They're basically going to all the Vic roads, whatever New South Wales, what are they called, NMR, or I don't know who it is, and they're basically cross-checking records of vehicle registrations. So I had a client recently. They didn't tell us about a luxury car they bought in the name of their company because they did it in the company because that was the easiest way to get the finance. So the car company said, just if you do it through the company, it's really easy because we don't have to go through the consumer credit law requirements. So I said, yep, fine, I'll register the name of the company. Didn't tell us about it. Did all the finance and was basically paying for it personally. He said, oh, look, Shane doesn't need to know, Aintree Group don't need to know about it because it's not for business use and I'm financing it privately. We get a letter from the ATO. We've checked Vic roads. This $300,000 car is in the books and therefore you're subject to FBT. We didn't do a logbook because we didn't know about it. So we got an audit. And what they did is they charged, the way it works, if you don't do a logbook, they calculate the purchase price of the car and multiply that by 20. So that came in at 60,000. Then with FBT, you gross it up by 2 roughly. So it went to 120,000. Then you pay tax at 47% on that. So the tax was 55 plus interest and penalties for 3 years. So it came in at 260,000, the total liability on a $300,000 car. So be very careful. Not too well, but we couldn't do anything about it because we didn't know about it.
How long did he or she have the car before we found out?
It was 3 years.
They had it for 3 years.
Yeah. And we only found out because the ATO sent us a letter saying this car is you've not paid FB, you've not declared this car.
All those charges for those 3 years.
Yeah. So interest at 11%, and then penalties for recklessness. We got that down to 20% the penalties, but they could have gone up to 75% penalties. Yeah. So on a $300,000 car, their tax was 260,000. Yeah. So the key thing is that if you're buying a vehicle, and this is not covering this part, but that's just an anecdote about being careful. If you buy it in the name of the company, you must tell your accountant, and also you must understand there's FBT on it, no matter whether you use it for business use or not, or whether it's, if it's registered in the name of a company, then it is subject to. So then we go to EVs, and at the moment there was a pilot program which is currently in play where EVs are currently FBT exempt, so 100% FBT exempt. In the budget, they've announced they're going to change that. So from 1 July 2027, so next year, 1 April, because FBT year is from 1st of April to 31 March each year. It's different to the financial year end. Only EVs under 75,000 keep the full exemption. That's on existing arrangements. And then from 1st of April 2029, that full exemption disappears and is replaced with a 25% permanent reduction for EVs. So they're no longer FBT exempt, but they still have discounted amount. But the way FBT works, it's a very expensive tax. And if we can avoid it, we try to. The best way to avoid or to reduce, I'm not to say avoid, shouldn't use that word, avoid tax. Thank you, Sharon. Best way to minimise your FBT exposure is to make sure you're doing logbooks for the cars and you can justify that business use because that drops the FBT dramatically. If we don't do a logbook, we have to apply 20% of the value of the car or the vehicle as the FBT each year. So,
Is the amount at the moment 92,000?
Yeah, somewhere around that. Yeah, it's around that number. That's correct.
So it's dropping.
Correct. Correct. Absolutely. So that's that one. But there's still some benefits in it if you're going to use cars in the business but it's got to be fully electric. It's not hybrid, but that's the other part too. Other key items. This one, I don't even know what this means yet, quite. They announced in the budget flexible PAYG installments. And I've done all this Googling and research on it. And the only thing I can come up with is that at the moment, generally businesses pay quarterly PAYG installments based on last year's tax return and what the estimated tax was. What they're going to allow you to do is basically work out what your turnover is for the month and what your profitability is, and adjust those POA installments and pay them monthly. I'm not sure where the benefit in that is. It's just extra administration versus paying quarterly. And we can always vary the quarterly ones anyway. So this one I'm curious with, and I need to see more detail, but it's available from 1 July 2027.
It's optional.
I don't know. I think so. I think so. Yeah, I think it's a thought bubble without much detail. Yeah, this one, if you're over 65, is not very friendly for you either. So private health insurance rebate is equalised amongst all age groups. So those over 65 are going to get less of a health insurance rebate. So you're going to pay more on your health insurance. So that's one thing to be aware of there. And that comes in from April 2027. Got to try and find some wins. Yeah, but again, this is the one with the sting in the tail. So proposed 1,000 instant tax deductions. So if you don't want to go through a tax agent or try and work out all your tax deductions, then from the 2026 financials, from 1 July 26 onwards, you can just claim an instant $1,000 deduction off your tax return without justification of the expenses you're incurring. So for people where they're not incurring much expenses on their tax return, it's a great one to simplify it. You don't have to go to a tax agent. You can just press a button, do it through your MyGov, and just get your tax return done really quickly, because I'll give you that instant $1,000 refund. So that's great for the employee. Not so great for the employer if you salary package. And this is the sting in the tail on this one. So the way this one works is that if your employee is going to claim this $1,000 straight off deduction, but you're going to salary package, I'll give you an example. Let's say Chelsea, I'm going to salary package her membership to some sort of business expense that she incurs, and it's tax deductible, normally tax deductible for her, and I salary package that for her. Normally that's FBT exempt. If she claims this $1,000 and I pay that expense for her, then that expense I paid on her behalf is subject to. So I have to actually find out what the employee's done, whether they claim that 1,000. This is logistically just, I don't understand it yet. They may come up with some great way to work it out, but I need to make sure she's not claiming that $1,000 deduction if I'm salary packaging things for her that she can claim a tax deduction for. You tell me, George, if you can work it out, you tell me, and then we'll be able to work it out together. This one's a good one for businesses where there might be peaks and troughs in their operations. So if they, at the moment, if you have a profit in year one and then you make a loss year two, you can't then offset that loss from year two against the profit and the tax you paid in year one. They're now allowing us to do that. They gave it as a small window during COVID. They gave us 3 years where we could do that a little while ago. They're bringing that back in. I think that's a great policy. I really like that one. So it means that if you paid tax in a previous year and then you have a loss this year, you can get some of that tax back. Now, there's certain criteria you have to meet, so it's not as simple as that, but I think that's a good policy. So I'll give that one a tick. Just standard ones, they always index the Medicare levy threshold. They're giving this new, don't spend it all. Oh no, this is a different one. So superannuation offset. So if you got income less than 45,000 and you put money into super, you can get a rebate off your tax. So you put up to 3,000 in, you'll get a decent rebate off your tax. So that's something, we don't see a lot of it, but it's something that's still worthwhile potentially. Working, this one, don't spend it all at once. $250. Everyone's going to get, if you're working, so if you've got a salary, you're going to get $250 rebate from the 2028 year. So you're not going to get it this year, you're not going to get it next year, you're going to get it the year after. And that's only when you lodge your return. So it might be another 6 or 12 months after that. But that's one where they're going to give you a little offset, and the measure is intended to support employees and sole traders and then low and middle income earners. So that's to help with the cost of living crisis, but you're not going to see that in your pocket for probably 2 years. Yeah, you will. Yeah. That'd be good, Steve. That's what you're earning 20 mil, aren't you? Yeah. No. Some last tax planning ones. So the good old Kerry Packer quote. I think everyone's seen the video. I normally play the video. I'm not going to do it this year, but just when and it's from a long time ago. But yeah, we're here to try and minimise your tax, pay the fair share of tax, and utilise the tax laws as they stand. So they're the individual tax rates for the current year. We've sort of gone through those before. Key things are that this bracket, as I mentioned before, too, is changing. So from 1 July, it goes to 15, then from a year after that, it goes to 14. That's going to give you a little saving. So on top of the $250, you're going to get this little bonus as well. So again, don't spend this one all at once either. I think it works out to $5 a week or something. So it gives you an extra coffee. Yeah. Company tax rates, 30% for a company unless it's a small business company, which is 25%. There's certain tests you've got to look at. There's a $50 million threshold for that too. And then superannuation funds in general are taxed at 15%. This Division 296 might mean there's more. And then, but on the flip side, if you're in pension phase, it might be less. It depends on your circumstances. This next one I really like, and I'm going to quickly go back. Anyone want to have a guess at what a definition of a small business is for tax purposes? Give me a guess. Anyone want to have a guess? Good guess? Yeah, yeah, that good guess. Yeah. Well, anyone else want to have any other guess? Yeah, that could be one. Yeah. Anyone else? Yeah. This is here you go. It depends. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different options on what you're looking at. So you've got to look at the tax measure to work out then whether you're a small business. So for the small business CGT concession, it's 2 million turnover or $6 million worth of net assets. If you want the instant asset write-off, it's under 10 mil. If you want the base rate entity, so the company tax rate at 25, it's under 50. Yeah, so that one you're right. But this is the joys of the tax system at the moment. So if someone says, "Are you a small business for tax purposes?" Correct, correct. Yeah, have a go at it.
The best one.
For tax, that's the best one for tax too. That's one thing on the small business. That's capital gains tax, small business concessions. The new rules regarding the 30% tax rate do not trump that. And I don't like using that word trump either, but sorry, they do not, they still apply. So you get to apply these concessions first before that 30% tax rate kicks in, right? I know that's very small because there's so many on it, but I love this slide because this is what we deal with. It's really hard to work out whether you're a small business depending on which circumstance it is. So yeah, so depending on the rules. So you see this one, so the new lost carryback one we just talked about is 1 billion. So 1 billion for a small business. I think, Gene, you're just about on that threshold, aren't you? Exactly. So there you go. That's a definition of a small business. Good luck with that. Just some basic tax planning for businesses, deferring income. So subject to cash flow and subject to not being fraudulent with the ATO, not creating invoices when you should or forward dating or whatever. But if you can defer income from 1 year to the next, it pushes the problem into the next year. It's a deferral, not a benefit. But from a tax planning point of view, if you can, look at deferring income. But on that, most businesses work on what's called an accruals basis. So whenever you raise that invoice, that's when the taxing point is, not when you receive payment. So that's something to be very careful on in that respect. Record keeping, the ATO, their integrity measures and their audit processes have improved dramatically. And we're getting much more interactions with the ATO in terms of certain things, cross-checking of income. If you're paying contractors, they're onto that one, and whether there should be superannuation or not. FBT, I talked about, that's a really popular area. For state-based taxes, Victorian State Revenue Office is dynamite on land tax at the moment, making sure you're under the right category for land tax. Their data sharing and their cross-checking is getting better and better each year, and they're pouring more resources. Part of the budget was putting more money into that. And what we're also getting is when, for instance, if we log into do your business activity statement, you've got payroll, that payroll data is already filled in the business activity statement. They already know that data. So we're getting more to that point where they're going to pre-fill revenue, and basically there won't be much to hide, if anything. Not that we want to do that anyway. We're all upstanding citizens who pay our tax and declare all our income. Bad debts. So if you've got any bad debts, you need to write them off before 30 June to get a tax deduction for them. So if you've been thinking, oh, look, I've tried, as long as you can demonstrate that you've tried every avenue you can to try and recover that debt. If you've got someone who's not paying you don't think you can recover it, if you write it off before 30 June this year, you'll get a tax deduction for it. Superannuation contributions, employer contributions, and same with personal. If you want to get a tax deduction for your superannuation contributions as your employer or personal this year, you must make sure that's hit the fund of the employee or your personal super fund by 30 June. So 15th of June is about the date we're saying. Don't leave it any later than that. Unless it's a self-managed fund where you're just doing a bank transfer, that can be done closer to 30 June, but you just want to make sure that. And then secondly, you've got to make sure you submit to your super fund a notice of intent to claim that tax deduction, because the ATO will deny the deduction if you don't fill out that form. So your super fund, when they receive a contribution from you, should be sending that out to you. You should be getting that in late June or early July. You need to make sure you fill that out and send it back to your super fund if it's Australian Super or Aware or whoever it might be. With your self-managed fund, if we manage it for you, we'll do that as part of the year-end compliance because we can do it that way. But you've got to make sure you fill out that form to get that tax deduction. We've had plenty of instances recently where the ATO said, we have not seen a notice of intent because the super fund reports that to the ATO. And if they haven't been reported to the ATO because the form hasn't been submitted, they'll deny the tax deduction. No. They'll send it out. Some of them send it out just before, but you should get it in early July, and you should look out for it if you've made contributions into super this year.
Shane, if you're a business that trades in stock, you've got a whole bunch of slow-moving stock you want to write off.
Yep, we're getting to that, but yes, absolutely spot on. Yep. And depreciation, so it's got to be installed ready for use to claim the depreciation deduction before 30 June. Prepayments, so again, if you're a small business, so 50 million turnover, you can prepay expenses. So if you want to prepay your rent or you want to prepay your insurance, prepay your accounting fees, you can do all that. If you do it before 30, you'll get the tax deduction this year, as opposed to having that incurred when you normally incur it. So if you've got higher income this year and then you know you're going to have lower income next year, it might be an opportunity to prepay something to bring that forward if your turnover is less than 50 mil. Family wages, making sure your family is doing work in your business, that you pay them. And that might be another way. And that is an actual way around these trust rules down the track, where if we've got a beneficiary normally paid, but we can justify that they're working the business, we pay them a salary instead of giving them a trust distribution. We'll be able to then get those lower tax rates that we talked about previously, but only to the extent that that wage is commercial. So that is one way to mitigate the trust rules if you're running your business through a trust. Asset register, so check obsolete asset items. So if you've got that computer that's been sitting in the asset register in 2012 and you threw it away out long ago and it might have a little residual value on it, write that off, get rid of it out of the asset register, claim the tax deduction for any residue that may apply. Trading stock, we just talked about. Oops, sorry, I accidentally pressed that button. Tax losses too. Again, if you expect that you might be in losses or there's substantial change in income, again, that's where you talk to us as your advisor or your accountant to make sure we're doing some proper planning. So we're making sure we're matching, we're not paying tax unnecessary in one year versus another. And the last one is mainly for us accountants and lawyers and financial advisors, insurance brokers. There's new rules which came in last year about professional profits and how we can't quarantine to get a lower tax rate. We're going to allocate a certain amount out for our own personal labour. And we're going to allocate 50% of the profits out of our business, if it's for labour, out to us personally. So professionals are paying more tax because of that. And now we're getting hit by the trust rules and capital gains as well. So all good fun. FBT, I talked about 47% is the tax rate. Due for lodgement. So if you've got an FBT return this year, it goes to 31 March, it's due on the 25th of June. And then anything you provide. So if you provide a short-term loan to an employee, that's subject to FBT if you don't charge a commercial interest rate on it. And there's a benchmark interest rate that applies. If you have the Christmas party and it costs more than $300 per head for your employees, that's subject to FBT because it's gone over the minor fringe benefits threshold. So all these things, anything you provide to an employee that might be private in nature, it's potentially subject to FBT. So just be aware of that. And they're increasing activity, and that's that logbook one I talked about before. Wherever you can, get a logbook done for your employees because that will mitigate the FBT. And then we've got the choice. If that works out to be a worse scenario than the 20 threshold, which is generally no, but if it does, then we can choose which method is the best way to do it for tax purposes. Working from home arrangements, they can be tricky as well. Then car parking is another one that's a sleeper. If you've got car parking, you provide that on premises and there's a public car park nearby, then that can trigger an FBT liability as well. So we've got to be careful of all these things. For individuals, personal income strategies, timing of capital gains. I'm not going to go through all these in detail, but timing of capital gains. If you're looking at selling an asset, it's the contract date, not the settlement date. So if you sign the contract today, but it doesn't settle till July, that's in the current financial year, that tax liability. So if you can defer things to the next financial year without jeopardizing the sale itself, then that might be something where you can defer that tax for another 12 months. So looking at those sort of things. Also, if you've got capital losses or if you've got capital gains and you've got a share that, so let's say you've got a capital gain, you sold BHP shares or Commonwealth, let's say Commonwealth Bank because they've gone crazy in terms of value. Commonwealth Bank, you've got a capital gain this year, and then you've got a dud stock, CSL has gone backwards. And you think, oh, look, I don't want to sell, I don't want to hold CSL anymore. If you sell that before 30 June, you can offset that against the gain. But if you sell that after 30 June, then you don't get to offset that loss against the gain, and therefore you'll pay tax on the gain, and then you'll have a carry forward loss the next year unless you find a gain to sell an asset to offset that loss against. So that's important to understand. Common deductions, motor vehicles, uniform, home office. They're cracking down on home office. We used to just say how many hours in the home office did you work, and we just apply a percentage. But there's a bit more record keeping required for that now. Yeah, so they're probably some of the main things. And super contribution cap for this year, 30,000. From 1 July, it goes up to 32,500. So they index it every so often based on inflation. And then if you want to make non-concessional contributions, it's going from 120 to 130. So they're great ways to get money into super if you qualify. There's certain restrictions on whether you can or can't. For instance, if your member balance is over 2 million at the moment and 2.1 from 1 July, you cannot make non-concessional contributions into the fund. And so you've got restriction in that respect. But a great way to get money into super, which is a low tax environment still. And there's some rules around if you're under or over 75 about meeting work tests and so on. Also, if your member balance is below 500,000, you can actually do catch-up super contributions from previous years. So you might have missed out on deductions. Here's an example here where we've got a taxpayer where we've got the last 5 years worth of contributions and we didn't meet the minimums and we've got some catch-ups that we can use. So in this case, we've got 24,000 we can catch up if we want to, which is on top of the 30,000 this year. So if this person wanted to put 54,000 into the super fund, they can, because it won't exceed the limit because they're catching up a prior year contribution. The key thing with this one, if this is of interest to you, is that every year that bottom one drops off. So if you miss out on using in this case, this is 1 year old, this one, but if you missed out on utilising that one, that'll drop off, and then you won't be able to claw that one back. It only goes back a maximum of 5 years based on the income year in which you're, or the financial year in. But that's a really good one that can work. But you then got to be careful about other consequences that may have too, and that's where you need to get advice on it. Family trust, we talked about the taxation. Family trusts are really important that we get the documentation and the processes right with family trusts. So again, review your deed to understand what the clauses are. Check what the income powers are. We've got the ability with trust at the moment, and we still will have this after the rules come in, but less beneficial, where we can stream different types of income. We can stream dividends one way, we can stream capital gains another way to different beneficiaries to get a better result. So making sure we've got the deeds. We do that as part of our service for our clients, make sure we've got those powers to then maximise the tax benefits. Confirm that the beneficiaries are actually eligible beneficiaries. So making sure that your deed is broad enough to include different people who you may want to distribute to. And you've got to get things done before 30 June. We're meant to do the distribution resolutions, working out how we're going to allocate the profits before 30 June each year. You can't leave it till after year end, because then the ATO can argue that you're contriving it and reverse engineering it. So they want you to make those decisions before 30 June. So it's really important the documentation's there. This one, which we've got a slide on, but I'm going to skip it. Section 100A, if you distribute to adult children from your trust, that creates some other layers of complexity that you need to be mindful of. The key thing with that one is that you must pay that. So if you allocate a distribution, so I allocate distribution to my adult son, and I allocate $10,000 in the trust to him, he's got an entitlement to that $10,000, and I must pay that to him within 2 years of that distribution. Otherwise, that's an invalid distribution and it gets taxed at 47%. So I lose the concessional tax, and even with that 30% bracket, it'll still be at 47% if I don't pay that money to that child within that 2-year period. So it's really important we're on top of those things. We want to utilise them for tax purposes. We also need to make sure we're complying with the rules. And then just if you're moving to or from Australia, there's capital gains tax consequences we need to be aware of. I'm not going to go into that in detail, but basically that's something to be very mindful of. Are you a trustee of a trust, which we talked about before? And the last one, I always put this in, is it too good to be true? If it is, then it is too good to be true. It sounds too good to be true, then it is. So, oh, I heard this, that I can do this and get this wonderful return, and oh, this, it's great, rah, 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 I'm getting 30, 40% return. When I hear those, it's alarm bells straight away. Be careful of scams, be careful of false promises. Even if the returns are 10 to 15%, be very mindful of what you're actually investing in and what the underlying security or the asset is that you're investing in too. So with those things, you should be getting advice on them before jumping into them blindly, because even with those ones where returns might seem reasonable for a bit of risk, they can still be quite concerning and go pear-shaped. And even with superannuation, you've probably heard of the Guardian situation, something recently where people are investing in superannuation and they've lost their money because they didn't look at the underlying investment and it was shoddy, and that money was taken by the promoters and never seen again. Unfortunately now, advisors and so on are paying for that by making a contribution. So financial advisors are making a contribution to a fund now to actually compensate those people for that because of poor financial advice given. And this is just to give you a bit of what's on the horizon. So payday super, which we talked about, comes in 1 July. Interesting, this is a non-compete clauses for employees. That's one that's coming in 2027. I don't think we've got defined, I can't remember the date on that one, but that's just where if you've got a non-compete clause in an employee's contract, that'll be watered down. So it's not as robust as what they have been. Allows people to change jobs freely without having those non-competes. Division 296 we talked about. This one, banks and financial institutions will stop issuing new cheques as part of the government phase-out plan. So cheques will be disappearing from June 28, and then from September 29, cheques will no longer be accepted. Cash is fine. I think that'll still be there. Still think it'll be there. We're nearly there. Bear with a couple more slides. Other opportunity, end of financial is a natural way of saying, let's see how many tabs you have open at once. Absolutely, I have too many tabs open anyway. This is a nice little one. So, get something back from the Victorian government. 20% rebate on your rego. Yep. Better than nothing. Sure, it is less than 250. Yeah. No, I think you have to apply. Yeah. Yeah, exactly. So go to the Service Victoria website. You probably might be able to do it on your Service Victoria app. If people have got the app, you might be able to do it through there as well. But there's one. So that opens from 1st of June. But see the finite time frame, 2 months. If you don't do it within that time, that's it. You're lost. You don't get it. All right. So everyone schedule their calendars 1st of June. Maybe leave it to the few days after that, because everyone will be probably a whole heap of people. Because I think they probably won't get the money if they don't get it, because the government will run out of money before they can get their hands on it. But anyway, so that's that one. Just checklist, end of financial checklist. This is all in. You can get all this on the handouts and so on. So this just things. Always end of financial is a great time to do some housekeeping. You get past 30 June, well, we do, and then we have a breather, and then we go through and we do some basic housekeeping to just make sure we're across all our matters that we need to deal with. So just making sure your record keeping is all up to speed. looking at maybe doing a cash flow forecast for the next 12 months for your business to make sure that there's no potential exposure there for peaks and troughs. Acknowledge and celebrate the wins is really important. So we're all very negative and we always complain about the bad things, but if you have a good year or you have a good outcome in something, celebrate it. It's always good to have the positive outlook as opposed to always looking negative. Could be. Yeah, it could be. Good point. But that's the thing, because we've talked about a lot of negative tax things that are coming today, but the sun will always come up. Hopefully the sun will always come up, and yes, this is tax. It's not the end of the world. We've got to do what we can to try and mitigate and navigate the issues that are at hand. And then, yeah, just some other things there as well. So personal goals, what do you want to achieve in the next 12 months, etc., etc. So just, looking on it from a positive outlook. And that is it. Sorry, it's gone quite a long time. There was quite a bit to go through, but that is it. Has anyone got any other questions?